Welcome to a video that I call the deep dive video. Every week I do a number of videos. I do a video each day. I do a weekly video. I do an intermarket analysis video. And then the last video that I do each week is I go through all of the daily charts and some additional charts that are unique just to this video. And I put them together and present this. I try to only include those charts in each daily video that are actually telling us something at that time. There's other charts that I use that have a story that unfolds each and every day. Well, sometimes charts come in, charts come out. I put them together into this video because sometimes we can get some insight as to what's going on by looking at charts that may not be blaring really loudly at us, but yet can still give us some insight anyway. This is being prepared for Tuesday, January 16th. This first chart is a chart of the VIX. We use the VIX to measure fear. When the VIX is high, it's time to buy. That's because there's a lot of fear in the market, even though it won't feel like that. And then when the VIX is low, it's time to go. That means that the market's doing really well. It's going up. The VIX is going down. And it might be worth it to at least explore getting out of any long positions that you might be in, but it's not going to feel like that. So we use a number of different charts to help override our emotions and give us some insight as to what we might need to do as far as making decisions. On this chart, you do see the VIX. Well, you don't see the VIX. The VIX is on this chart, but I turned it invisible. And then over top of the VIX, I put a 50-period exponential moving average. Typically with the VIX, we'll use static numbers to try to get our reading of the VIX itself, 12 to the downside, which is down here near the bottom, and then 20 to the upside. Well, over a period of time, you can see that we don't always stay within those static numbers. The VIX is also dynamic and it can change. There are periods of time when we get up into a higher range, and then we're back into a lower range, then a higher range. Over on the right-hand side, where it looks like we're starting to enter a phase where we're going into a lower range. We don't use this to make decisions. We really just use this for information to kind of give us an idea of the overall climate of the market. We also want to see how fast is the VIX moving. And a good indicator to do that is the RSI. And I plot it using 9 periods. And when the VIX is really moving, it'll give us an extreme positive or negative reading. Now, this goes in the opposite direction of stocks. If the VIX is going down, that means stocks are going up. If the VIX is going up, that means stocks are going down. And we're not getting any kind of an extreme reading right now, so I haven't been including this chart. Also, we look at another index that is similar to the VIX because the VIX measures the volatility of stocks, and that's in the middle area right here. Well, we also keep an eye on the volatility of bonds. And what I found to be most helpful is the correlation between that's here on the bottom between bonds and stocks. And right now they're having a pretty strong correlated relationship. That means their volatility is tending to move in the same direction at the same time. Sometimes stocks are more volatile, and believe it or not, sometimes bonds are more volatile. Right now, they're both about even with each other. Then we look at a ratio between the VIX and the MOVE index, stocks versus bonds. And when this is going up, that means that stocks are a little bit more volatile than bonds according to this measurement, but we can see that the moving average is actually moving down. So volatility in both has been decreasing, and that's what we've been seeing as the market has been improving throughout a lot of 2023. And even right now, as we're seeing improvement in bonds as we ended 2023 and are moving into 2024. Then we look at a ratio between the VIX and then the VVIX. The VVIX is the volatility of the VIX. It's a measurement of the VIX indicator. And we look at a ratio because we can get some insight from this. When this is going down, that means that typically volatility is going down, and that tends to be more positive for the market. Now we're seeing this kind of level out here right now. We got off to a pretty difficult start in 2024. We also had a big economic report this past week. CPI came out, and there was an awful lot of hedging ahead of that report, and it's kind of tinkered with a few of our indicators, even longer term indicators. So if the market turns back more positive, we would expect this would still continue to decline the way it has been, if we turn more negative, then this would start to go back up. Then we look at a VIX and then a 3-month average of the VIX. This is also starting to tick back up in the short term as we started off roughly in 2024. But overall, it has been declining. This is also showing that fear is decreasing as the market has been going up. Then we have another measurement that's similar to the VIX index. This is called the skew index, where the VIX uses at the money options to calculate where it's at. The skew index looks at out of the money options, either above or below current prices, to calculate where it's at. And sometimes we get some extreme readings when we get up into this red area. Now, sometimes that may mark a top, sometimes it may mark a bottom, sometimes it may mark a continuation. The last reading that we had here was pretty much a continuation. Right now, we're just about in the middle. So we're not getting any kind of an extreme reading at this time, which is why I haven't been showing this chart. Then we had an interesting thing happen before the CPI came out on Thursday this past week. We saw the equity put call ratio just skyrocket up. Well, that's the 1-day chart. It also, because it was such a big move, it also has bumped our 5-period chart up into an extreme positive reading here. And that's usually what happens. The equity put call ratio tends to go up as the market's going down. Well, when we get above this red line, that's an extreme reading. And a lot of other times, if you look at when we really spiked up and then started to come down, that often marks some kind of a bottom in the market. So right now, it's a little bit confusing, but depending on when this ends up topping out and then coming back down, that could end up being positive for the market. There's another version of this chart that's a lot shorter term, because we look at this on a shorter term time horizon. This is a longer term look at a chart. And I use that every day in the daily videos. And then when this is really starting to tell us something, I'll also include this chart. Then we look at a long-term equity put call ratio based on 253 periods. That's typically the number of trading days in a year, give or take. When this is going down, that means that the market is improving. When this was really going up, this was 2022, and we were running into a lot of problems. Now that we've been declining as the market has been improving, but we're also possibly starting to tick back up in the short term. And there are other times when we go down and it kind of blips. It doesn't mean it goes straight down or straight up. We'll have to see if it can resume going down. If it continues to go up, that probably means in the longer term, the market is turning more negative. Then we just want to keep an eye on where are we from the all-time high, and we're getting very close. In fact, on an intraday basis in Friday's session, we actually went above the closing high set back in January of 2022. We haven't set a new intraday high yet. That's why this line is just slightly going down. But on a closing basis, we are now 0.72% from the all-time intraday high. This figure is going to be a little bit different than what you may see elsewhere because they base it on the closing high. I base it on the intraday high. But this is, again, just for informational purposes. Stockcharts.com has this service where it triggers what are called technical alerts. And if it's positive, it tends to be blue or green. If it's negative, it tends to be red, where it looks at not only the S&P, but different sectors, different indexes, different markets. And when something happens, it's triggered. We read this from the bottom up, where you can see over on the right-hand side, this was January 8th when this was triggered. And it typically will print the first trigger right after the open or when it's first triggered. And then as the day goes on, other triggers then come in as we get closer to the close. Up on top, this was the last signal that was triggered in Friday's session. When we see an awful lot of red, that's more negative. When we see an awful lot of blue or green, that tends to be more positive. Then I mainly focus on 5 different indexes. I look at a lot of indexes, but for this particular study, I just look at 5 indexes. Everything that I teach and all the strategies that I do and I teach about focus on the S&P 500. Well, there's other indexes, and those indexes can have an influence on the S&P 500. I look at the Dow, we look at the NASDAQ 100, of course, we look at the S&P, we look at the mid caps and the small caps. StockCharts.com has a rating scale that's unemotional. They've fed some different parameters into this so that you're not, oh, I think this is happening, or this is what I think, how I should interpret this chart. It's trying to just be mechanical in this. And the higher the score, the better looking the technical chart. And we've seen some changes recently in this. In 2023, the QQQs, which is the ETF for the NASDAQ 100, that was doing about the best. Then, as we were apparently experiencing the January effect, which seemed to kick into gear in December, which for right now seems to have gone away. We don't know if it's going to come back or not. The Qs really dropped down in their ranking. Well, now they're coming back in, giving us the highest score at 90.3. The higher the score, the better looking the chart. In second place is the Dow at 87, where it's been doing okay and hanging in there a little bit better. It's been under some pressure lately with the news coming out of Boeing, since that's a component of the Dow, and other companies that really have an impact, because those are only 30 stocks, where we're looking at over 500 stocks for the S&P. Then in third place is the S&P, coming in at 82.1, where it tends to be holding up a little bit better. And then this was doing really well. The mid caps, we got up into the 80s here in December, but now we're really dropping back off. And now we're getting a score of 38.9. And then the mid cap or the small caps were also, they were getting up into the 90 range. And it looks like they were doing really well. Well, they've been chopping sideways, giving some of their gains back. And so their technical chart has really been showing a lot of weakness. And we're now coming in with a score of 25.4. And you have, if I'm not sure if you have access to this as being a member of stockcharts.com or if it's a free tool. I'm a member, so I get my information that way. But you can apply this to a stock, you can apply it to a sector, you can apply it to an index. I just use it for looking at indexes. In the short term, I have a thing called a rainbow, and that's because of all the cool different colors here. And we go from 10 periods with a simple moving average up to 50 periods of a simple moving average. And I try to look at this whole chart together, going way over on the left, all the way over to the right, getting a big picture look at the short-term trend. When we're above all of the lines and the lines are going up, that means we're in an uptrend. And that's what we're experiencing right now. When we run into trouble, that's when we see the lines start to cross over each other and look more like spaghetti. But since we come up out of this low from October, this has been showing a lot of improvement. We also have a number of short-term indicators. One of them is called the Stoch RSI. This tries to take the stochastics and RSI and put them together, and it's a pretty touchy little indicator. And typically, if we get moving in one direction or the other, we get an extreme positive or negative reading, and you can see that we can stay positive or negative for extended periods of time. Right now, we're just about in between. We're not getting an extreme reading. We have a couple of other short-term indicators that are already extreme, but this is not one of them, so I haven't been showing this. Another one that I look at is the CCI, or the Commodity Channel Index. It was developed originally for commodities, but it also works with stocks. What's kind of interesting is I have another chart called the CCI 20 based on 20 periods. That's already giving us an extreme positive reading, which is strange because usually when we're really moving, the CCI 14, which is based on fewer periods, that tends to go extreme positive first. And then if we continue to go up, the CCI 20 then goes extreme positive after that. But we're seeing just the opposite right now. Then I have a thing called the boom indicator. And I developed this indicator decades ago. I just came up with a name a few years back after I was attending an online webinar. And somebody was trying to explain, okay, when we get too far away from a moving average, boom, we head back towards that moving average. And so I just ended up calling it the boom indicator. And we can use this on a number of different time frames. What is price in relation to the 20-period moving average, the 50-period moving average, and the 200-period moving average? And then we can use this like an oscillator. When it gets too far away, that gives us an extreme reading, either positive or negative. The last reading here was extreme positive, and then we have a tendency to move back. We also look at this with the 50-period. We haven't had an extreme reading now for a while with the 200, although we were dropping below the 0 point here for a while. and then we bounced up out of that. So that's really what this just measures, is kind of a reversion to the mean, or a reversion to the normal price. Then some intermediate term charts. I have another rainbow here going from 50 periods up to 100 periods, and we're well above all of the lines, and the lines are starting to go up. So this is suggesting that the intermediate term trend is still positive. Then we have a thing called an anchored moving average. Most moving averages go from a point that you determine and say, okay, now calculate 20 points out, or 50 points out, or 200 points out. The interesting thing about this type of moving average, you can set it at a starting point and then it calculates going forward. And we started to go down below this when we were running into problems last October, but we were able to bounce up off of that. That's this red line that I'm highlighting here. And now that we're far away from this anchored moving average, I haven't been showing this chart. We also have the Connors RSI, which is pretty much like a regular RSI. We use it like a momentum oscillator, where when we're going up, that means the momentum is positive. When we're going down, the momentum is negative. And then we look for extreme readings, either positive or negative. And this is pretty spastic. It really moves around a lot each day, but we don't get an awful lot of extreme positive or negative readings from this. And we're not getting one now, which is the reason why I haven't been showing this chart. Then I'm really focusing on the 20-period moving averages right now. That's where the S&P is at the time I record this. We have the 20-period moving average acting as support, and we tested that support this past week. We have the all-time high acting as overhead resistance, and the market's right in between those. Well, if we really start to fall and we go below that 20-period moving average, the next moving average that we'll keep an eye on is the 50-period moving average. And the debate goes back and forth. Do you use exponential moving averages or simple moving averages? And there's been some studies done about this, and people have their opinions. I just go ahead and plot both. And sometimes that can give us some insight as well. When we see the blue line above the red line, that means we're going up faster, because the exponential moving average moves quicker than the simple moving average. But if we do fall below that 20-period moving average, we'll be looking to see, is the 50 going to end up providing some kind of support? We're far away from that now, so I haven't been showing this chart. We also look at the 100-period moving average. And there was a period of time back in the mid-20 teens when we were going higher, but we weren't really trending all that with a lot of conviction until we hit about 2016. And that's when I started to really implement the 100-period moving average a lot. Usually you go 20, 50, and then 200. Well, we need that kind of in-between moving average to give us some more perspective. This is also showing that we're going up because we're seeing the exponential moving average, which is in red, above the green moving average, which is the simple moving average. And this is an area that we'll keep an eye on if the market starts to develop weakness. And are we above or below the 200-day simple moving average? When we're green, that means we're above. And so far, we are positive since we're above that 200-day simple moving average. Then we look at standard deviation. Now, this doesn't measure direction. This measures speed, whether it's a stock or an index or a sector. When this is going up, that means we're moving really fast. When we're below the moving average, that means we're not going all that fast. Then we look at a percent B indicator. Bollinger Bands are very popular, and they have a lot of different uses. When price is moving up or down, it spends a very short period of time either closing above or below the Bollinger Bands. That's what the percent B indicator measures, the time that we're above that. And we actually spent 4 days above the upper Bollinger Band back in December, and that's long. That's a lot longer than what we usually see. We usually go up into that area and then turn and go in the other direction as the Bollinger Bands adjust and price moves forward. Right now, we're positive on this chart because we're above the midpoint, but we're not getting an extreme reading. Then we look at the thing called the CMB Composite Index. This is supposed to be a standalone trading system. I don't use it like that. I use this like an oscillator. When we're above this black line, that's extreme positive, and we spent most of the month of November extreme positive and a large part of December. Right now, we're not getting any kind of an extreme reading, so I haven't been showing this. The mass index is not generating a signal right now. We only pay attention to this when it climbs back up to the red dashed line and the blue line. That's when we really focus on this chart. Since we're far away, there's no need to show this one. Then we've been keeping an eye on the S&P 100, which is on the bottom, and the S&P 500, which is on top, because sometimes they get out of line with each other. Earlier in 2023, we were seeing the S&P 100 really moving up, meaning the big stocks that make up the S&P 500, where the S&P 500 was going sideways. Well, lately, we've been kind of seeing the opposite of that, where the S&P 500 has been doing better, where the S&P 100 was actually underperforming. Now, this past week, we had an up week, and we're seeing things improve a little bit with that. Whether to take that positive or negative, okay, back last spring, that just means the mega caps were outperforming, and that tends to help the indexes. It may not help individual stocks that you own, but if you invest and do different strategies, like in the S&P 500, like I do, that didn't bother me all that much. Then it can also be encouraging when we see the S&P 100 underperforming the S&P 500, because that means that we're seeing more broad participation with a greater number of stocks. So that could be positive as well. Then just to measure where we were at, it looks like we did hit the low in October 2022. I think that's pretty much been established now. And then we came up out of that. We hit a high on July 31st of 2023. And then that's when we started to run into some problems. We hit another low back in October of 2023. And now we've been bouncing up from that. We're not quite back. You see how this is sticking up a little bit above this line here? That's new all-time high territory that at some point, if the market is positive, we're going to go up and set a new all-time high. If the previous all-time high is acting as resistance, then we may see some weakness from here. We've been seeing this move up on a decrease in volume, and that doesn't give us an awful lot of conviction. We want to see volume pick up, and if price then follows that, that would give us more confidence that the new all-time high is really having some strength behind it. We look at a point and figure chart, which does not take time into account. These X's and O's, that's measured when a stock or an index moves a certain number of points. And it could take an hour or it could take a year. So time doesn't play into it. But when it goes up, there are X's that are drawn. When it goes down, there are O's that are drawn. We didn't see any new X's or O's drawn this week as we've been chopping more or less sideways between the all-time high and the 20-period moving average. So nothing new was generated on this chart. This also generates signals, which the last signal was a double top breakout that was triggered on November 20th. Then we have the Copic curve, which is another momentum oscillator, which has actually been declining lately. So I've been including this in the list at the end of each video that I do. I just haven't been showing the chart. The Pring bottom fisher, it was trying to generate a buy signal here as the market was going up. This typically generates buy signals after the market's been going down. So I really haven't been taking this chart all that serious. And it's just about getting ready to the point where it's crossing below its moving average. Then we compare stocks with 3 to 7 year bonds. When this ratio is going up, that means the market's anticipating a soft landing. When this ratio is going down, that means the market's anticipating a hard landing. A soft landing means, yes, there's economic weakness. Yes, the Fed is raising interest rates, but we probably won't head into a recession. That's what the market is trying to shoot for. When we do go into a recession, then that's known as a hard landing. And right now, even though we've been pulling back just a little bit, when you take all of this together, the market still is anticipating a soft landing. Then this is a newer chart where I'm measuring the S&P 500. That's the black bar chart here. And then we have the NYSE advanced decline line. Now, there's an advanced decline line for the S&P 500, but this is a broader measure looking at all of the NYSE. That's the red line that you see here. When this is going up, that means that we're seeing more broad participation. When this is going down, we're also seeing broader participation in the broader market. Where the S&P has been going up and we've been seeing this advanced decline line going down, that's a little bit of a negative divergence to us. But when we look at the trend, that's what the moving averages are here. They're measuring the red line. When we cross the blue over the red, that means that we're seeing an uptrend with the NYSE advanced decline line. So even though we're seeing a longer term positive trend, we're seeing shorter term weakness. So we want to keep an eye on this one. Then we look at discretionary versus staples. Discretionary is more growth oriented. That tends to do really well when the market is more in growth phase, where staples, that tends to do better when the economy is really slowing down. And then we take a ratio between the two. That's on the bottom. Where for a while, discretionary was really outperforming staples, but now we're seeing this really pulling back. This is another warning sign that we're keeping an eye on. This is producing a bit of a negative divergence. As the S&P was going up on top, we were seeing this ratio actually start to show some weakness. Then some long-term charts, we have another rainbow going from 50 periods up to 250 periods. We're well above all of the plotted moving averages here, and the lines are smoothing out and starting to go higher. This suggests that the long-term trend continues to be positive. Then we have a thing called the special K, and this is another oscillator, but it's a long-term oscillator, so I don't show it in every video because we don't get a lot of signals. The signal is when we cross above or below the red line, which is a moving average. And we're above this red line, even though we've been flattening out, we are still positive, so I haven't been showing this chart. Then we look at a correlation of a weekly chart of the S&P on top and a weekly chart of the German DAX in the middle, and then look at the correlation between the two. And so the German market and the S&P longer term on a weekly chart, their correlation is pretty strong with each other. So what's happening in Europe also tends to happen in the US, at least right now. But there are times when they have a tendency to move in opposite directions, but right now they're moving in the same direction. If one is going up, the other one's going up. If one's going down, the other one's probably going down as well. Then we have a kind of a unique study here. It's not helping us right now, but we take the 10-year yield in the US and subtract the German 10-year yield. And since US rates are higher, that gives us a positive result. Then what's interesting about this is sometimes in the middle, we plot the US dollar index, and there can be a really strong correlation between the top chart and the middle chart. And that's what we measure down here at the bottom. Unfortunately, you see the correlation is really dropping off. So this correlation that we had been seeing that was stronger back in 2023, it's not really all that strong right now. So we're not finding this chart as useful. Then some different support and resistance. I haven't really been showing any Fibonacci retracement levels because we're still below the all-time high. We're kind of in no man's land right now, and we're not down to this 61.8% retracement level. So it's like, okay, this chart really isn't telling us anything until we go back and set an all-time high, or unless we see some weakness and come down to this other level. And then this is a longer-term Fibonacci chart where we also continue to be in no man's land. The NASDAQ also, and we have quite a ways to go to get to the all-time high for the NASDAQ. The NASDAQ 100 has recently set new all-time highs. Those are the biggest stocks in the NASDAQ is the NASDAQ 100. But this is the whole broad NASDAQ itself. So further on, if the market continues to go up, we're going to want to see the NASDAQ confirming new all-time highs if that ends up being what happens. Then this is an Ichimoku cloud, which really you just take the price of whatever you're looking at, and then you have some moving averages that are shifted forward. Because sometimes if we're above and coming down, this cloud may act as support. If we're below it and then we bounce back up, it may act as resistance. We're far above the cloud right now, so we haven't really been using this chart. And then here's another Fibonacci measurement using the NASDAQ 100, and notice how we have been breaking out and setting new all-time highs here. We're just a little bit below that right now, just about at the all-time high, but we want to see this really break above. Now, the reason why we watch the NASDAQ 100 is because there are a lot of stocks in that index that are also in the S&P 500 index. So if the NASDAQ 100 is doing well, typically the S&P 500 is doing well, and vice versa. And we keep an eye on the financial sector, which really has been doing well lately. Unfortunately, in Friday's session, a lot of banks' earnings reports, the really big banks, came out, and they weren't really well accepted. So we ended up being down. But we have been showing a real improvement. If we start to really turn and go down with this sector, we'll be watching where this red line is. This is a pretty major line of support, but we're far away from it right now, so I haven't been including this chart. And here's a trend line study. And since we're above all the different crazy lines that you see here on this chart, I haven't been showing this either. If we do see some weakness and come back down, then I'll be pulling this chart back out. And as new things happen, I will end up drawing additional lines on here. Some broad market measures. This is the Vixen, where we look at the VIX for the S&P 500. This is the Vixen is based on the NASDAQ 100. And I don't use this bar chart here because it looks like icicles falling off a side of a house or something. I look at mainly the line chart, and I don't even use that all that much since I focus mostly on the S&P 500, but we still want to keep an eye on this. This is continuing to go down, and it's below its moving average, suggesting there's not a lot of fear in the NASDAQ 100. And we do a ratio between the QQQs, which is the NASDAQ 100, and the diamonds, which is the Dow. And right now they have a pretty strong correlated relationship. So if one's going up or down, the other one's probably going in the same direction at the same time. The bank ETF, which had been showing some real improvement after it took a dump last March with the banking crisis and then went sideways, it's generated a recent golden cross, but you can see where it's kind of starting to trail off here a little bit now, but it's still positive longer term. Then we compared the regional bank ETF with the financial sector, and that had been showing enough of improvement here to generate a golden cross. But lately, we've been seeing some weakness as earnings are starting to come out. And that's where the market's at right now. It's like, okay, these big banks, they came out with their earnings, and the market didn't really like that. Is that kind of foretelling us what's going to happen with earnings season as a lot of other companies start to report? And the market's a little bit edgy over that right now. Then some rate of change charts. I use these for information purposes. We look at Friday's close and then go back 250 periods. This has actually been coming down a little bit lately. When it's going up, that just means the longer term trend is up. Here's a longer term look at that same chart going back to 1980, where it has been declining recently. And then we keep an eye on bonds, where we also compare them with stocks, where the red line is the S&P 500, the blue line is the long-term bond ETF, and we look at the longer-term correlation between the two based on 50 periods, and they have a tendency to move in the same direction at the same time. But shorter term, when we look at a 10-period correlation, that relationship is really starting to weaken, meaning that they may go in opposite directions in the shorter term. And then on the bottom, I have different ways of measuring the spread between the two. It's not really all that helpful, just kind of something that's interesting to look at. And then we look at a correlation between the Qs, which is the NASDAQ 100, and the TLT, which is the long-term bonds, and they still have a pretty strong correlated relationship. When we get a real high reading here, that means they're going in the same direction at the same time. And then we keep an eye on the yield curve. The two most important ones are the 10 to the 2-year, which still remains inverted, and the 10 to the 3-month, which is also inverted. I have another couple of yield curves on here, but they're positive now, but they're really not all that influential. And then we look at the comparison between stocks and bonds. When this is going down, that means bonds are underperforming stocks. Well, you could take that another way, and I have another inverse of this same chart. When this is going up, that means that stocks are outperforming bonds. Then we look at the 1 to 3 month T-bill, which you could pretty much call cash. We compare it with bonds. When this is going down the way it has been, that means that folks are a little more confident about interest rates. When this is going up, that means this was during the summer months, and that's when stocks were under pressure. Interest rates were starting to go back up because the market was thinking back in here in late spring, mid to late spring, that maybe the Fed was done. And then the Fed came out and said, no, we're not done. And that's when we started to show this going back up. Now it's starting to come back down, and that tends to be more positive for the market. Then we look at a thing called TIPS, which are shorter term inflation protected securities. And these adjust and they're shorter term. So you can roll them over into a higher interest rate. Those are the types of investments you get into when you're concerned about interest rates rising, because every time you roll it over, the idea is that you're going to roll it over into a higher interest rate. Well, when interest rates top out and start to come down, now you want longer term investments. And here we have the 3 to 7 year bond ETF, and we do a ratio. When this is going down, which is what it has been doing, that means that inflation worries are decreasing or subsiding. And then we look at tips and then take a further out look at bonds where this has also been declining. It's bounced back up as stocks and interest rates were under pressure a little bit the beginning of 2024. But for the most part, this has been declining, meaning that the market is not really worried about inflation right now. But that could always come back at any time. But this chart also suggests that the market's not really concerned about inflation. This is the home construction ETF versus bonds. If this was really going up, that means that the home construction, which is very sensitive to interest rates, this would be going down the way it was over the summer and into the fall. Well, now that this is going back up, that means that the market is not as concerned about interest rates. And then I have a number of charts called the possible positive scenarios. I usually use these when we're really going down and it looks like we're setting some kind of a bottom and then we're getting ready to bounce up out of that. But these charts are still very useful on a day in and day out basis. For example, this one, this is the percent of S&P 500 stocks that are above their 200-day simple moving average. And when we're above the midpoint and going up, that's positive. We've been falling back just a little bit, but we're still positive longer term. Then we look at some 50-period moving averages with the S&P 500, where we did get extreme positive right at the end of 2023 into the beginning of 2024. And we used this like an oscillator that was giving us an extreme positive reading. And now it's been coming back down, even though it's still positive. And then we look at the mid caps, which gave us an extreme reading and has since been coming down. And we look at the small caps, which were doing really well, but now have been under weakness. Then we look at a 19-day exponential moving average of the advanced decline ratio for the S&P 500. Back in late 2023, we were getting extreme based on price as well as volume, and now we've been coming down. But we're still positive because, at least based on price, because we're above zero. We're starting to drop below zero based on volume, and that's what we're seeing right now. We're seeing volume really lead things a little bit more negative than what we're seeing in price, and that's another area that we're keeping an eye on, and I'm trying to bring that up in every daily video because that could eventually come in and really bite the market. So thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. I hope you have a really great weekend, and I will talk to you in the next video.